All right, candle range theory trader back with you with a video explaining the best time to trade the candle range theory model. So let's not waste time. So we have to remember that we're dealing with a basic three candle pattern: the range candle, consolidation candle, and the expansion candle. This expansion candle needs to be our primary focus. We need to be laser focused on how this candle acts and how it behaves the way it behaves. Because we have to remember that the candle range theory is a time and pattern based model because we're only trading one candle at specific times of day, be it on the 4 hour, daily, or 8 hour chart. Now, this presentation is going to be based on the 4 hour and 8 hour chart. So, because of this, the best time to trade is the first 1 to 2 hours of the candle. Okay, from the open price to the first 2 hours. Because think about it, you have a 4 hour candle. That candle shouldn't take 3 hours to play out for your setup to appear. Okay, based on this pattern right here. You have a wick up, and then the majority of the time is spent in expansion. It is not spent in consolidation. The consolidation happened back here. Okay, so this candle should be doing this if you're on the right side of the market, but the majority of the candle. So you shouldn't be trading 4 hours waiting for this to happen. Does that make sense? I hope so. So why do we look for it to be that way? Because, like I said, we're expecting a straight drop or a straight rise or just a trend, not chopping around and not an indecision. Okay, if it does that, obviously we're wrong. We need to get out of the trade. So this is what we want to see when everything's said and done. When you start trading, first off, you'll either see no wick. You'll see the price open at say 9 a.m. and just do a straight drop. Done, like nothing. Like you could have entered right at the candle open price and just been straight in profit. That can happen. Okay. The most common when you're right is going to be a small wick where our price will retrace a little bit, but the majority of the time is going to be spent in expansion to the downside or upside. And then lastly, you may also see a small wick, price expanding and then retracing. Okay, it can close in a doji pattern, but this doesn't mean you still can't make money. You just have to have your take profit set or a level at which you want to get out. So this is what we're expecting. We're not looking for any other candles, especially ones with big wicks either to the top side or to the bottom side. Okay, now obviously these are short examples, but for a long example, just flip them upside down. It's the same thing. So if it doesn't behave like that, get rid of it, cut it. Okay, so the higher low of the first candle in terms of price levels to pay attention to, we need to pay close attention to the first candle that happens, that opens and closes on the 5 minute chart on the candle that we're trading. And ideally, that candle's higher low should hold or shouldn't be broken by that much. Okay, and then the second price level we need to pay attention to is candle's open price. This is how it should look, or a rough idea. Just a general sketch where you'll see the candle open, it may go up a little bit and then just start to retrace and lower highs is how they when you have the stereotypical trend. And I'm sorry, higher lows. So that's a low, that's a low, that's a low. And then lower highs here, that's a high, that's a high, that's a high, or higher highs. I always forget how to phrase that. But you see, it should pattern, it should trend like this when you're trading. Or if you're long, it should trend like this. So notice the high of this first 5 minute candle, ideally it holds if you're right. The low of the first 5 minute candle when price opens should hold when you're right. That doesn't mean price won't touch it a little bit, but it shouldn't just slam through it and just keep going. No, that's a bad sign. Okay. So here's some real chart examples. Here's some shorts. So we have our range candle, the manipulation candle, and then our expansion candle to the downside. This has a tiny small wick at the top. Here's the open price right here, this black line. Okay, that black line right there is the open price. This is the first candle's high. See how price retraces into it just a little bit, taps it, and then tanks. This is what you're looking for if you're short. This is exactly how the pattern should play out. Can it retrace? Yes, it can, but notice it still comes back out because for the day, the trend is, or not for the day, but for this 4 hour period, okay, the trend is down. All right, so this is what you should see. Don't let these retraces scare you though, because like I said, price, as long as this high holds, you're good. And as long as the open price holds, you're good. Okay, here's another example here. Here's our range candle. This is actually range candles here. A couple of candles of manipulation. This is a longer candle range theory, but at the same time, here is the distribution right here. Okay, so this trade was amazing because it played out. You had 33 pips in 10 minutes, right? Where as soon as price opened, bam, it slammed down. Now, will that happen every day? No, but can it happen though? Yes, and you need to be ready for that. There are some times where if price is close enough to the candle range high, if you don't just want to hop right in and set a stop loss right above the high, this can be you. This can be your trade, and you're out in 10 minutes. This is a 5 minute chart. Okay, all the charts on the smaller time frames are 5 minutes. Okay, here go a couple longs. So we have our basic candle range theory, range candle manipulation, and the expansion to the upside. Here is let's find our open candle right here, this first red candle. Okay, this black line right here is the open price. You see how price did go down there a little bit. It did break it some, but not tremendously so. We have a couple of railroad tracks here, and there was news at 230 that caused the spike up, but the entry would have been from 130 to 225. You could have got in anywhere down here around the open price and enjoyed all that upside. Okay, here's another example where you have our range, manipulation, and expansion, but this is the one where we talked about where it can spike up and then retrace. That's where we got this from right here. Okay, this one, except it's long, okay, because price can open, spike, and then retrace. And this is a real example that will happen. So you need to be aware of that. Okay, so this is the spike up and the retrace. So let's take a look at our entry. So this is a 9 a.m. candle open. So the open price is here. That's the first one. The low of this candle held. Okay, first candle is very important. That low wasn't even threatened. Once it closed below, we call that a change in state of delivery. Or once it closes above this first candle, we call that a change in state of delivery. And then it was a straight rise to profit. That would have been it. It would have been done. So your best entry was from 910 to 925. So as you can see, it doesn't take all day for the entry to appear. You just have to be in front of the chart when it does. Now, for the best times, all right, this is based on, again, the 4-hour or 8-hour chart. These are all the opening times. So if a candle opens at 5 p.m., 5 a.m., either way, okay, or 1700, okay, for the 24-hour clock. If you want to trade, let's say London session, your best times to trade are 5 to 7, ideally 5 to 6. Remember, and then the first hour, that's like prime time. Okay, first hour of the candle, and then the rest of the candle is spent paying you. Okay, that's what you want to see. Let's see for the next one. 1 a.m. and as well, sorry, if you're trading 1700, just be sure to give it an hour before the market reset, so the market reset can calm down. That way you can go ahead and let that spread tighten up and then enter the trade. Don't trade during the dead zone when the gap is like 30 pips. We don't do that. Okay. If you're trading the 1 a.m. or 1 p.m. candle, trade 1 to 3, but 1 to 2, the first hour of the candle is the best. And then if you're trading 9 a.m. or 9 p.m., 9 to 11, but 9 to 10, the first hour of the candle is the absolute best. Okay, so just the first hour. If you really want to be deadly, trade the first hour of the candle. So in conclusion, the best thing to see is a straight drop or rise once the candle opens. If the first 5-minute candle matches their bias, that can be a sign you're on the right track, but it's no guarantee. But the first candle is very important. The higher low of that candle ideally should hold. Okay, that's going to be one of your main clues. Now, in terms of how large the wick should be, you can backtest that for yourself. I don't include a lot of screenshots because I want you to do that yourself. That's your homework, because if you're serious about your business, you're going to be willing to put in the time, just like I had to do. Okay, I'm not asking you to do anything I didn't do. So, but I'd say about 10 pips or so. But simply stated, if your price is short, you shouldn't be 10 pips above the price open, and if you're long, the price shouldn't drop below 10 pips of that candle open price. Okay, so it should be fairly short. Of course, you always want to manage risk, scale in. If you're expecting a straight drop, why not add to the position? When you're right, you want to be right big. But when you're wrong, if price goes up, against you, just get out. And then that way you'll have capital to take another trade when it appears. Okay, they're going to be there either every 8 hours or every 4 hours. Okay, so the longest part that you need to wait for is for your take profit to hit, but not for the entry to show up. Okay, but because of the way the candle range theory is formatted, you should not be waiting all day to take a trade. You can shorten your trade to 1 hour per candle, period. Okay, you do that, you lessen your time of over trading, and you increase the time where you're just waiting for the profit to roll in. So this model dictates that the trade shows up immediately. If it doesn't, you just might be on the wrong side of the market. So that can happen. So just be aware. So appreciate your time and attention. Thank you so much for watching. Go back test this, take a look at it for yourself, and have a great day. Take care.